From the News Channel 5 Network, this is OpenLine.
Hello, everyone. Welcome to OpenLine. I am Ben Hall. Very good show tonight, talking about something that's on a lot of people's minds. It is tax season. So what are some changes to the tax code? What are some ways you can save money? What do you need to be thinking about right now as far as tax season? And we are very happy to have with us someone who can answer all of those questions and more. Dr. Friday Burke, thank you very much for being with us.
It'll be
tax specialist.
Yes.
Had your own show here for a long time.
I did. I seem like I'm always still coming in and out. I love it.
So as we get started, of course, we want to hear from you. Phone call 737-plus, 737-7587. Any question you may have. I want to start with big mistakes people make. What are some of the big ones you see?
Believe it or not, putting the wrong Social Security number on your tax return.
That would be big.
Yeah, or nowadays everything checks with Social Security Administration. So you got married and you did not change your name, but when you did your taxes, you used your husband's name. So putting the wrong name on your tax return. Whatever you have on your Social Security card has to be used on the tax return, okay? So it's kind of important. The government has a funny thing. And probably the biggest is claiming the wrong children.
And don't people that's a big deal, right?
Yeah, that's a huge thing. Because let's use a scenario, you have a girlfriend that lives with you and they have children, and you're under the impression that you should be able to get earned income credit because you support them. Not going to happen. You can try, and then what happens is the IRS will kick you out, so if you ever have your own children or anything else, you will never be able to claim earned income credit. So you want to be very smart about that. It has to be a descendant of yours, or a foster child, or an adopted child. That's what it has to be. So a girlfriend's children is not related to you. You can claim as a dependent. You cannot get earned income credit on them. And the other mistake is people both claim the same child.
I bet that happens a lot.
Yeah, because one's mad at the other, so whatever happens, divorce is great. But anyways, only one person gets the claim, and it really is first in. So whoever claims the child first most likely will get to have that credit. Even if you had the right to claim that child, you will be fighting for it.
And that's one of those things you work out in a divorce, right?
Right,
I mean,
but usually
you kind of go back and forth.
Lawyers are great at making things complicated, right? So if the one person's paying child support and they are not up to date, then they don't get to claim the child. Or even if they're up to date and the spouse doesn't like you any longer, they still, because the child is living in their household, you are most likely going to still be able to control if that other one. So, I'm just saying there's a form that has to be released every year you give that other person. Well, if the person doesn't like you, how often are they going to sign a form to release the child, right? So, and it's not something the IRS will not get in the middle of a court. I mean, that's law. IRS says first in, we're taking it.
Another big mistake people make is just not filing at all, right?
Huge mistake. Number one mistake, if I guess we're going to stack them up or whatever, because a lot of people don't know they need to file, or leaving money at the table. That's probably my biggest one. I hate leaving money at the table. So when you don't file, a lot of times you're thinking, well, whatever. But I mean, think about it, $5 million, I think it was $5 billion 3 years ago, so it was like 2010. You can't get 2010 refunds anymore, so the government got to keep all of those refunds. How much of that was your money? That's my question.
$5 billion?
$5 billion was left on the table. Now, that may have been for the last couple years, but bottom line, you couldn't get any of that money back any longer. You can only go 3 years back to collect money.
And what are some of the reasons you hear people say, nah, I'm not going to file, or I didn't file?
Well, again, I hate harping on people that are divorced, but it's such a good subject. Usually because a lot of times the ex will get the refund because they're behind on child support or something like that. It's most the unusual one.
Okay.
So if you're behind on student loan, or you owe state income tax in other states, or you owe child support, all of your refund can be paid towards those debts. Now, to me, that's free money. You've already paid it in. Why not get it and give it back to something that you're paying off? Let the government pay it off at that point, then just leave it and then lose it. That's just silly.
And we're already getting a few calls. I want to take calls in a moment, but as we set the table here, what are some of the big changes this year? I mean, there's a lot of talk about the Affordable Care Act, Obamacare, and people having to pay a penalty.
Right.
Is that a big change? What are some of the big changes?
That's probably the biggest, because we all know that they basically extended everything from 13 to 14. Okay, it all expired again at the end of 2014, so we have no idea what they're going to do in 15. But for preparing your 2014 taxes, pretty much everything was extended. But the new thing is the Obamacare, what we refer to, the health care penalty, which is going to be a minimum of $90, $45 for kids. If your income is higher, it can go up to 2% of your adjusted gross income, whichever is higher. So most people are probably going to get hit with the minimum of 90. Now, there are waivers and exclusions we can get into. If you're interested, pick up the phone and call us.
And we already have people that are doing that, so let's go on to the phone. It's always interesting to hear. Let's go to Derek. Hello, Derek.
Good evening to both of you.
Hi.
I have a question on inheritance that my brother and my sister have that was left by our parents. And basically, they had a couple of accounts in 2 different banks. They had a credit union account. And after the probate and everything was settled, we got all of that, basically our check wrote to us by the executor. So is there nothing we have to do as far as what I've been told in Tennessee as far as paying any taxes to anybody?
Well, I'm going to make a wild guess that the estate was less than $1 million.
Altogether, excluding the house, yes.
No, the entire estate, including the house. Was the estate over $1 million?
No, close to it, but no.
Okay. If it was under, then we don't have an inheritance tax in Tennessee, and it has to be much higher for the federal, so there's really no inheritance tax. The only thing you would have to confirm is if any growth happened in those accounts, meaning interest or dividends, that would pass through to you or was filed. Depending on when the person passed away, you'd either file a 2014 tax return, for example, for the person that passed away. They would pay the tax and interest on all that, or it passed along to the 3 of you, and each of you would be responsible for a third of it. But that would be the only thing that I can think of if it was in bank accounts. Now, if it was IRAs or something like that, a tax-deferred account, then any money you took out of those would be taxable.
Oh, okay. All right.
But if it's just in a bank account, the only thing you would have had, and we're not earning a whole bunch of interest right now in this world, but if there was a little bit of interest, that would be the only thing that you guys would be responsible for.
Okay, because right now they do have, we found out there was an account that didn't even get put in through probate that was a mutual fund.
Okay. Well, mutual fund, usually there's an investment. So let's just say, for example, you had that they invested $50,000 in that mutual fund, and now you cash it out and there's $100,000. $50,000 of that would be taxable income to you guys, just as an example.
Taxable income.
Yeah, so whatever was not the investment. So,
right.
If the investment was 50 and it sold it for 100, we have $50,000 growth. That would be split 3 ways, and you guys would be responsible.
And the inheritance tax in Tennessee, I thought they had done away with that.
Gift tax. We have not gotten rid of our inheritance tax yet.
Okay. All right. So that threshold is $1 million.
Yeah, which doesn't affect a lot, only small business owners.
Right. Let's go to Dawn on line 3. Hello, Dawn.
Yes.
Hi, what's on your mind?
Well, I've been listening to her. She answered half of my question for me. I was going to ask how much what the penalty was. I think she said about $90 at the most.
Well, at the least.
Okay. And I was also wondering, is there a limit on how much that you make a year in order to pay that? Is there any clause in that for what you make?
There is. If you're considered low income, you don't have to file taxes, or if the premiums you have are more than 8% of your household income, there are exclusions.
Okay. Well, I can tell you, I don't know if you can figure it out, but I know my yearly income, it ain't going to be no more than like $15,000. So what do you think about that?
Are you married or single?
I'm single.
Okay, so you first $10,000, you would be considered poverty or low income, so you would not have a penalty.
So you would not have a penalty. All right, well, that's good news. And now I think people have a lot of variations on that very same question.
Absolutely.
Because
so
this is new.
It's going to be different for everybody, and there's going to be exclusions. For example, it may be that you were insured for 9 months, but you lost your insurance. There's an exclusion for that. As long as you've been 3 months or more, less of not having insurance, you can get a waiver. So there are things you will be able to get waivers on depending on your situation. There's even some personal things. I mean, if you had a utility bill where they, what's it called, where they shut you off.
Okay, right.
If you have a disconnect from a utility company within the year, you got a waiver. Even if you were just bad payer, apparently you get a waiver. But there are other exclusions in there, so it kind of works in there. So you really need to know or talk to somebody to make sure if you're going to be paying it or not. Because
and we're about to go to break, but this is another one of those things that's phasing in, right? So last year it was a little lower. This year it's a little higher. Is it even higher next year?
Yeah. So I think the next 3 or 4 years they'll keep going up. I think it's like 245 is what it's going to go up to.
Wow, 245. Okay, we're going to take a break. If you have a question, there is the number, 737-PLUS, 737-7587. If you're on the line, hold on. We'll get to your call. I'll be back right after this.